Good morning, everybody. Welcome to Windsor Brokers live daily market outlook for Tuesday, 26th of February 2013. Another turbulent day behind us. As main driver for euro yesterday was the result of the Italian elections. Basically, the still turbulent times are ahead of the ahead of single currency, as the Italy finds itself in a major political mess with the Senate in a state of deadlock after no party won a majority. The lower house, which will be controlled by Pierluigi Bersani's center-left coalition, does little to help recovery in sentiment. The results show a fragmented Italian society where almost 1/4 of the population failed to turn up at the polling stations, but most worrisome of all is the situation in the Senate, where even the Monti's support, neither Bersani's nor Grillo's party will be able to pass key laws. It appears to heightening fears about the non-viability to the pursue the same austerization path Italy had undertaken under Monti's technocrat government. Not to elaborate more about this, but just to say, as a result, the euro has recorded the strongest daily fall yesterday since January the 3rd, after a briefly holding above 133. Barrier 133.17 was all seen, and then the downside accelerated, lost the previous low at 131.44 and dipped as low. This was morning's low at 130.17. That looks likely, as that confirms basically the lower top of the larger downtrend from 137.10 high of 1st of February 2012. Another top loser for on yesterday's trading was dollar yen. Despite yesterday's gap higher opening of over 100 pips and extension to the marginally fresh high at 94.55, a steady reversal from the later level accelerated after filling the gap, which was the closing price of last Friday at 93.38, and then sharp decline lower, dipped as low as 90.85, clearing the important and breakpoint level at 92.00. That was also the near-term consolidation range floor, with brief bounce higher and close briefly above 92.00, still seeing as not enough for some more significant recovery, as the pressure is still evident on the near-term structure of dollar yen. As said, Italy remains the main story. The elections in Italy, as this was one of the main triggers for the yesterday's strong movements, especially in a single currency. Still important things are due to happen today, as Fed Bernanke is due to testify today in the Congress, and he is facing the first of 2 days. Today, starting the first of 2 days congressional testimony that will subject the Fed's controversial bond buying program to tough scrutiny and gauge his confidence in the resilience of the U.S. economy. This is coming just a week after the Fed's meeting minutes sent U.S. stock reeling by suggestion that central bank could pull back its economic stimulus earlier than had been expected, and the day after another sharp stock market dropped. Investors are certain to hang on every word that comes from the U.S., especially the Fed officials. Beginning with the U.S. Senate Banking Committee, today the Fed chief will be quizzed by some bitter critics of aggressive steps he has supported to spur the growth. On Wednesday, he will appear before the House Financial Services Committee. His opinion remains that there is still not enough growth, that high unemployment is a cyclical issue, that there is not enough inflation. Our comments about the Fed's had Bernanke's later today testimony. and the Fed chairman prepared this testimony that is due to be released at 15 o'clock GMT today, followed by a lengthy question and answer session. By tradition, he will issue the same statement on Wednesday tomorrow before facing the House panel. A quick look at the calendar as we started with the calendar. We have the inflation report hearings from Bank of England due at 10 o'clock GMT. Bank of England Governor King had a speech earlier this morning, and he stressed that monetary policy should be conducted for domestic reasons, and if they follow this rule, then global economic growth will accelerate. A group of 7 countries were in agreement that no country should intervene in foreign exchange or have a specific target for their currency, but that if a country is pursuing policies to boost the domestic economy, this could cause the country's currency to fall, King said after giving a speech today in Tokyo. Further from the calendar, basically this is realized sales from UK are due at 11 o'clock GMT. 16 is the forecast compared to 17 previous month. More significant data coming from states. Along with the Ben Bernanke speech, we have the house price index for December due at 1400 GMT. No changes expected, 0.6% in December compared to 0.6 in November. S&P Case-Shiller Composite 20 metro area home price index for December is, according to the forecast, expected to jump by 6.7% compared to 5.5% in month of November 2012, and this is according to the expectation. If the result comes, that would be another supportive element. As said, Fed chief is due at 1500 GMT. At the same time, we have the Richmond Fed Manufacturing Index for February. That is, according to the forecast, showing improvement. -4 is today's consensus compared to -12 of the month of January. And then new home sales for January from the United States, 381,000 new homes is forecasted to be sold in January compared to 369 in a month of December. Another improvement, and then another significant. All these in red are quite a red calendar today. Consumer confidence for February, again significant improvement seen in today's forecast. 60.8 is the consensus for February compared to 58.6. That if comes close or around or above these figures, could be another good signal for a stronger recovery, for the further recovery of the U.S. economy. New Zealand trade balance is due later in the afternoon. 110 million Kiwi dollars seen as trading surplus compared to 486 million in the month of December 2012. And the Japanese retail sales for January due at 2350 GMT drop to -1.4% compared to 0.3% increase in the December 2012 seen in January. And this is all for today's calendar. Basically, more focus is still seen towards the United States as a number of important economic indicators, along with the speech of testimony of Fed Big Boss Bernanke, are keeping the focus on the second part of the day, where the majority of economic indicators are due to be released, and according to their importance, again the focus is shifted towards U.S. economic indicators. Now they look at the currencies and the commodities to see the technicals and expectations for the coming session. Starting with the euro, it made the strongest daily fall since January 3rd, 2012, after brief peak about 133. This was marked, if you remember yesterday, marking the strong support, the previous range floor. Basically, the price did not manage to sustain gains above 133. It was capped by descending 55 days exponential moving average on the 4-hour chart, and then a sharp acceleration lower through 131.44, 131.00, dipped as low as 130.17 this morning, where the congestion now is seen between the lowest 130.17 and the upsides so far the 130.88 previous session high still holds the upside. Basically the negative tone still dominates. We might see some corrective action as hourlies are quite extended as well as 4-hour indicators, but overall negative tone still sees more focus toward the downside as the recent break lower confirms basically the gains stalled yesterday just ahead of trend line, main bear trend line of 137.10 resistance. That keeps the downtrend firmly in play, and the more significant is was basically break below the channel support that was around these levels around the 130.60-70 area. That increases bearish pace for possible test of the downside targets. We'll be looking for extension down towards 130.00 as initial target, and then 128, pardon, 129 or 128. I'm not quite sure. Where do we have this? 128.76 is the 50% Fibonacci retracement of the entire rally of 2012 low at 120.42 to 2013 peak at 137.10. That will come as the next focus for the single currency, as of course in case of extension lower. As I said, the bearish outlook is still keeping the downside in focus, while any reversal, any recovery faces initial resistance at 131.44, the previous low. That is also equivalent approximately to close to 50% retracement of the entire yesterday's fall. That comes at 131.67, and this zone is also reinforced by descending 55 days exponential moving average. Overall break above 131.50-60 zone, 50-70 zone I would say, is seen as a break point that would prevent bears from further extension and allow for some stronger recovery. However, any break higher requires clearance of 130.15, yesterday's high seen, pardon, 133.15, seen as a minimum requirement in order to avert immediate downside risk and allow for some stronger corrective action. But on the 4-hour chart, we're still quite far from any more significant signal that would come, I would say, on a break above 133.60, where is the 50% retracement of the entire 130.17 down move. For now, more bearish outlook is still favoring the downside, and the 130.00 seen as immediate target, but more significant, as we said, 128.75, 50% halfway of the entire 120.42 to 137.10 rally. This is rally from 2012 low 120.42 to 2013 high at 137.10. British pound is in the near-term recovery mode, filling yesterday's gap after the price dipped to 150.69. This was the lowest price yesterday, and then steady recovery followed. Now we are approaching important, basically we were capped, the price was capped at important resistance that marks approximately 61.8% of the whole down move from last Friday, and yesterday's gap lower opening and bottom at 150.69, 152.20 was the level where the price was limited so far. Also, this marks the bottom of the multi-year range. 152.30, 152.70 zone has so far limited. As we can see, the beginning of European session, the sterling is again accelerating lower. However, still a slightly positive tone seen on the hourly chart, sees potential for some stronger corrective action, especially that the price managed to fill yesterday's gap, and may look for some stronger corrective action. Still, this will be seen as correction, as a larger downtrend from 163.80 high of 2012 posted 2nd of January, still firmly in play, unobstructed, and the most likely scenario is a visit of initial 150.00 target, with the bearish extension slightly being delayed now by the current corrective action. However, being the losses, the gains, pardon, the recovery being capped at 152.20 Fibonacci and 20 days exponential moving average for now sees increased risk again of sliding down to yesterday's low at 150.69. That will open our initial downside target at 150.00. The notion is supported by negative studies that are still not showing any firmer signals of a reversal on the 1 and the 4-hour chart. 4-hour chart. Hourlies are already slightly positive, but reversing lower following the current move that keeps again bears more in focus, unless we see a gain of, as I said, 153, first break above 152.30.70, and then regain of 153.15, and not much to be expected of the current recovery. It could be described as corrective action preceding a fresh weakness, with 150 seen as the next downside target. As break there may open support, which is at 148.71. This is July 2012 10 low, and then more significant, of course, is 142.30 May 2012 yearly low. That will be seen as the main focus in case of a break below psychological 150 support. Dollar yen was the top loser yesterday. A sharp slide, as you can see. First was the gap higher opening over 100 pips that posted marginally fresh high at 84.55 versus 84.45 previous one, and that was all seen from the upside action. Then steady descent came out. Expectations were quite positive for the yen. I mentioned yesterday, in case of not filling the gap, then probability of visiting 95 zone peak of 2010 is quite high, and the positive outlook was seen after the temporary support was found at 93.66, and the recovery came up above 94.00. However, the fundamentals and news that came after turned a strong acceleration lower, with the pair dipping as low as 90.85, clearing the important support and the higher base at 92.00. Now the subsequent bounce higher that resulted in close above daily close above slightly above 92.00. We closed at 92.16. Still did not produce much, as the price again dipped to 91.40. Now we have to see a break above, clear break above 92.00, and I would say more significant regain of 92.80, 93.00 would be more supportive, and would look for some stronger recovery. Basically, we need to see the today's, in case of the stronger recovery, today's close above minimum 92.00, and return back to the range. But strong big red candle seen on yesterday's trading is seen as initial bearish, strong bearish signal. Of course, we have to see today's action, where is going to be today's movement closing, especially. Then that will give us some more clear picture. Still to confirm a bearish breakout, we need to see the break above, break below 50% retracement of the uplift from 86.81 to 94.55. That currently stands at 90.67, and then we have the break point at 90.30. This is the high of 21st of January and low of 29th of January, and break below these two levels would be a strong signal that dollar yen is in the corrective near-term corrective mode of 94.55, yesterday's fresh high. Again, focus still more to the downside, but current recovery sees potential for some stronger bounce. Of course, we need to see the today's close to define the further movements. Overextended the hourly conditions that with all indicators now starting to point higher, see potential for recovery. The 4 hour are still in the negative mode and still need a lot of work on the upside in order to improve and confirm the positive structure again. Set regain of minimum 92.80, 93.00 would be seen as initial supportive element and would prevent the pair from the further sliding. Possibly also is that the move yesterday was driven by news and fundamentals, and usually these things move the market, but then quick recovery follows up. Since technicals were dented on this move, that could be additional support for the stronger bearish action, as daily indicators are in the strong descending path and building up bearish momentum that overall could produce some stronger corrective action of the larger rally that was that commenced from 75.56 yearly record low of dollar yen, and the base at higher base at September 2012 low at 77.12. That hasn't seen so far any more significant corrective action based on the weekly chart. This is the first one that shows some more significance, and most likely would be a signal for some stronger reversal of this strong rally since September until yesterday. And finally, dollar Swiss was not much affected on yesterday's movements, though the pair dipped as low as 92.30, breaking below the initial 92.80 range base, but quick recovery that posted even marginally fresh high at 93.37 and the daily close above 93.00 still sees potential for an upside extension towards our main upside targets, 93.81 and 93.87. These are the key barriers, break of which is required to confirm the base at 90.20 and open way for a more significant recovery of the larger downtrend from 99.70 peak of 2012 that so far dipped to 90.20, with the basing attempt being quite evident at this area. Break above 93.87, that also marks approximately 38.2% Fibonacci retracement of the entire slide. Is seen as an initial requirement to confirm the base and allow for stronger recovery. That will open a 94 psychological and a 94.33 where the 200 days moving average currently stands. On the downside, initial range floor at 93.80 opens, range floor at 93.80, pardon, 92.80 offers initial support ahead of yesterday's spike low at 92.30 and 92.00 as the previous range floor, break of which would be quite risky for the near-term price action. Break below 92.0091.80 will revive bears and the sideline bulls on their attempt towards 93.81, 93.87 target. So far the structure remains well supported and the picture looks good as 20 days exponential moving average underpins the advance, holds the downside with the slower 155 days at 92.50 underpinning the current action, and still more focus is seen towards the upside, especially that daily indicators are still in the positive mode, though some sideways movements are evident on the recent congestion at 93.30, 93.40 zone. Break above here and the regain of 93.81, 93.87 will be seen as fresh bullish resumption towards 94, 94.33 200 days moving average. And Quick look at commodities. Crude oil remains under pressure after failure to capitalize on the break above the range tops, consolidative range tops since last Friday at approximately 93.45. Extension up to 94.44 was all seen, and then sharp slide lower, tested $92 per barrel, with the more pressure still seen towards the downside on both lower time frames, 1 and 4 hour charts, as evident. The bears are still quite evident following a loss of 95.00 previous range floor and base that opened way for a stronger corrective action. So far, nearly 50% of the entire 85.20 to 93.86 range has been retraced. That signals we need to see the clear break below 92.00 to confirm the bearish breakout and confirm the double top that was created at 98.22, 98.63 previous two tops, and the possible test down at 90.46, where is 200 days moving average, and 90.33, 61.8% retracement. The daily studies remain supportive for the bearish action for now, and this looks as a good base for further extension lower, especially that the price already broke below 55 days moving average. The next one is 90 days one that is currently at 90.90 ahead of 200 days moving average that is at 90.46. Overall, we are still in the bearish tone and still looking for a further extension lower as the price penetrated the daily Ichimoku cloud with the cloud base seen at 90.75, a break of which is to confirm on the daily. 4-hour Ichimoku studies are firmly bearish and see downside firmly in focus for now, and only break above yesterday's spike high at 94.44 along with the regain of 94.54, 38.2% retracement, and the 55 days exponential moving average would produce some stronger recovery signals. Otherwise, focus remains still on the downside. And finally, gold, that remains in the corrective mode. Currently is testing 1600, very important resistance. Okay, we have it here. It's approximately, it's a previous support psychological barrier, also equivalent to 38.2% Fibonacci retracement of the down leg from 1683 to 1554, reinforced by now sideways moving, pardon, 44-hour chart, 55 days exponential moving average, and the break here as initial barrier, and then 1620 approximately, which is the previous high of 18th of February, as well as 50% retracement, seen as a confirmation of a stronger recovery. That, of course, will prevent further slide towards critical 1520 support zone, multi-year base. Current recovery is still seen as corrective as a part of the larger down move from the latest down leg is from 1700 zone. This could be still seen as corrective, but as the price returned back to the channel, broke above the already broken channel support line, this is still seen as corrective action. But of course, as I said, a regain of important Fibonacci levels, 1600 psychological also, and 1620 would bring some more positive tone, and most likely scenario is seen of today's stretch towards 1620 as 4-hour indicators are now improving and building up bullish momentum. Of course, some hesitation could be still seen at this level. This is quite a strong barrier, but likely scenario still sees extension up towards 1620, our next target, as hourly indicators are also holding a positive tone. while daily situation is showing a recovery as most of indicators are now emerging out of the oversold territory that keeps near-term focus still at the upside as a part of the recovery from 1554 that is currently regaining testing 1600 psychological and Fibonacci resistance. And that will be all for today from my side. If there is any question, I'll be very glad to answer, so you can type them and send them right now. Yeah, okay, it seems that everything was nice and clear today. To be honest, I was talking a lot and I got a bit tired, so there is no problem if we miss the questions for one session. Thank you all for being with us. Quite a busy day ahead of us again, most likely continuation of the yesterday's action. Keep an eye also on the markets, especially on the second part of the day where quite significant releases are due from United States, and expect to see you again tomorrow morning at our regular time at 8 o'clock GMT, 10 o'clock local Cyprus time. Until then, I wish you a nice Tuesday, and of course the most important thing is successful and profitable trading. Good luck.